Before we dive in, hit subscribe so you don't miss new episodes. If you find value, click the like button so we reach more people. Let's get started.
Okay, let's unpack this. We are diving into the fascinating world of private jet financing today. Looking at the notes, it seems like there's definitely more than one way to, well, get your hands on one. Our mission really is to figure out these options, loans, leases, maybe using a jet you already have, and understand what actually goes into making that choice.
Exactly. And knowing why these options are so important is key. I mean, private jets, they offer amazing exclusivity, real efficiency, but yeah, they come with a pretty hefty price tag. So the right financing strategy, it's not just about paying for the jet. It's really about making sure that huge asset fits with your bigger financial picture, your
Yeah.
operational needs, getting that flexibility you want without, messing everything else up.
Right. So when you look at funding one of these beasts, where do most people start? I'm guessing the old-fashioned way.
Well,
A loan. That's generally it, yeah. The most common path is a traditional loan. You can think of it, well, almost like a mortgage on a house, but obviously for an aircraft. You get the funds, usually from a bank or maybe a lender who specializes in aviation. And the jet itself, that's the collateral for the loan, you see.
okay. And what kind of numbers are we talking about there? What did the sources say? Terms, LTVs?
Well, typically, lenders might finance somewhere between, say, 70% and 85% of the jet's price. That's the loan to value, the LTV.
Gotcha.
Interest rates, they can be fixed or they might float, often linked to benchmarks like SOFR, and repayment terms usually 5 to 10 years. Sometimes you'll see a structure with a bigger balloon payment right at the end.
Okay, that makes sense if ownership is the goal. But what if you just want the use of the jet, maybe without having this massive asset sitting on your company's books?
Oh, right. That leads us straight into leasing. An operating lease is a really popular way to go if you value flexibility.
Mhm.
And yeah, sometimes the accounting treatment is different. Essentially, you're renting the aircraft for a set amount of time.
So lower upfront cost, I'd imagine, less cash out the door initially.
Precisely. Much lower upfront cost compared to buying outright. You avoid that big down payment. And the lease terms are usually shorter too, often like 3 to 7 years.
Mm.
A key thing the notes mentioned is the potential for off-balance sheet treatment. That can look different on the financials, sometimes better depending on the company. It really suits those who think they might want to upgrade or change their needs down the line.
Got it. And then there's the finance lease. That's different again.
It is, yeah. A finance lease, some call it a capital lease, it's more like.
Uh,
Well, it's structured as a path to owning the jet eventually. The payments are set up to cover the aircraft's full value over the lease term. And typically at the end, you actually take ownership.
so higher payments than an operating lease.
Generally, yes, higher monthly payments.
Yeah.
But the upside for the lessee, the person leasing it, could be tax benefits, like getting depreciation deductions. Depends on the tax rules where you are, of course.
Okay, so we've covered buying with loans and these two types of leases. What about the notes mentioned using a jet you already own? Leveraging it somehow. That sounds interesting.
Ah, yes, equity release. That's aimed at individuals or companies who own their jet outright, or at least have built up a good chunk of equity in it. They essentially use the jet they own as collateral to get a new loan.
And why would you do that? Just to pull cash out?
Pretty much, yeah. It generates liquidity. You get cash.
Yeah.
And that cash can be used for all sorts of things, maybe other investments, growing the business, managing cash flow, and you don't have to sell your valuable aircraft to get it. These loans, though, tend to have shorter terms than the ones you get to buy a jet, usually more like 1 to 5 years.
Okay. And what if you need money really fast? Maybe just for a short period while you sort out the main financing?
Right, that's where bridge loans fit in. They're specifically short-term financing. You use them to actually buy the aircraft while you're still lining up the permanent long-term funding. The advantage is speed approval is usually quicker because the lenders focus mainly on the immediate collateral, the jet itself. But the catch is they generally have higher interest rates because they're meant to be temporary.
Makes sense. And then for people who don't need, a whole jet just for themselves or maybe want to share the costs.
Now, you're talking about fractional ownership and things like jet cards or memberships. Fractional means you literally buy a share, a fraction, of a specific jet. You share all the costs, capital, maintenance, crew, management with the other co-owners. A separate company usually handles all the day-to-day running of it.
And jet cards are even simpler.
Much simpler access, yes. With jet cards or memberships, you're basically prepaying for flight hours on a certain type or category of jet from an operator's fleet. There's no ownership involved at all. It's just pure access, maximum flexibility, no asset ties.
Wow, okay. That's quite a menu of options. So with all these different ways to finance, What are lenders really zeroing in on when they decide, okay, yes, we'll fund this, and what the terms will be?
Well, the sources lay it out pretty clearly. It always starts with the borrower's creditworthiness. Lenders dig into net worth, liquidity, how much cash you have access to, your debt-to-income ratio, or DTI, and just your overall credit history. Strong financials are absolutely fundamental.
And the plane itself, that matters too, right? Not just any jet.
Oh, definitely. The aircraft type and its current value are huge factors.
Hmm.
Newer jets, ones that are well-maintained, from well-known manufacturers. They're preferred as collateral. Why? Because they tend to hold their value better over time. Lenders will also look closely at the loan structure and terms they're proposing, basically asking, can the borrower actually afford these payments? They'll look at cash flow projections, especially for businesses.
Does it matter how you plan to use the jet, like business versus personal?
It can, yes. Aircraft utilization is something they consider. Is it mostly for corporate travel, personal use, maybe even put up for charters sometimes? That affects the risk profile and potentially how income might be generated from it. And finally, they have to factor in all the regulatory and tax stuff. Rules about depreciation like Section 179 in the U.S., or maybe luxury taxes in other places. These things impact the total financial equation and can sway the financing terms. And sort of behind the scenes, they're also gauging if the buyer really understands the other costs, maintenance, crew salaries, insurance. The total cost isn't just the loan payment, right?
Right. The sources also gave some quick examples, case studies showing how these different options play out in the real world.
They did. They gave sketches like a corporation maybe going for a finance lease, not just for the ownership down the line, but specifically using those depreciation benefits to help their tax situation while keeping more cash free up front. Then there was maybe an individual using equity release or perhaps a loan backed by their investments using their existing wealth without having to sell those investments, which fit better with their overall strategy. And a charter company needing to grow fast, maybe using an asset-based loan, basically borrowing against the jets they already own to quickly add more capacity. It just shows how the best choice really depends on the specific situation and goals.
So if we pull this all together, what's the main thing to walk away with here?
I think the key takeaway is that financing these executive aircraft, it's a complex area with a lot of different tools available. You've got traditional loans, different kinds of leases, ways to use existing assets, even shared access models. There's no single best answer, the optimal path. It's completely tied to your specific financial setup, how you plan to use the jet, and what the tax and regulatory environment looks like for you.
Yeah, and maybe consider this. How important is actual ownership to you compared to just having guaranteed, flexible access whenever you need it? Asking that question, or thinking about whether you'd prefer to leverage assets you already have instead of taking on fresh debt. That immediately points you down very different financing roads. It's less about picking off a list, more about finding that perfect structural fit for what you want to achieve. Thanks for listening. If this helped or made you think, hit like it shows this content matters. And tap subscribe if you haven't yet. See you next time.